Oh boy, is there a lot to say today. What happened yesterday, what all the chatter was about, and what's going to happen this morning at 8:30 when the producer price index comes out. Good morning, I am Kenny Polcari, your host of the party, and today is Thursday, July 14, 2022. And here's what you need to know. CPI boils over, making a mess on the stove. So what will the PPI do today? The Fed is now expected to go 100 basis points on July 27th. The ECB is now in focus. How is Christine Lagarde going to respond? The dollar strength is causing commodities to back off, yes, but that doesn't mean that we're completely out of the woods yet. And what do we have for dinner? Well, let's go with the potatoes and eggs because you can have that for breakfast, lunch, and dinner. Okay. It is really hot in the kitchen. You can hear inflation sizzling on the front left burner while the recession simmers on the back right burner. Rising interest rates are cooking on the front left burner while job losses are heating up on the rear left burner. The CPI now bubbling over, creating a mess all over the stove. Stocks were all over the place yesterday, but ended the day solidly in the red, and they're redder this morning. The Dow gave up 210 points or 7/10. The S&P lost 17 points or 0.5%. The Nasdaq gave back 17 points or just about 0.2%. And the Russell ended basically flat, down 2 points, while the transports lost 171 points, down 1.3%. Oh, yes, good morning. And it is the day after. And we are now all trying to understand what happened yesterday. The CPI coming in much harder than expected at plus 1.3% month over month versus the estimate of up 1.1% and 9.1% year over year versus the estimate of 8.8%. While CPI ex food and energy was equally as hot, coming in at 0.7% month over month and 5.9% when expectations were 0.5% and 5.7% respectively. And all that means is inflation is not just about food and energy, because when you take food and energy out, you still have higher inflation, higher than expected. So this idea that inflation is under control is nothing but, well, let's just say it's not under control. Joey telling us that it's not as bad as the numbers should suggest, that in fact the report is already out of date. Yes, out of date. Well, that's not so helpful or assuring. Remember the whole transitory argument? How helpful was that? How long did they run with that narrative? Do you realize that inflation has been around since April of 2021? That's 15 months ago with no end in sight. And by all accounts, it's expected to be here for at least another 12 to 15 months. That's 2.5 years. And that's just their best guess. Because what is clear is that nobody has control or insight into the rate or pace of rising prices. Look, go back and read some of my notes from last year. I made it clear that they have been stimulating since March of 2009. Right? March of 2009. Today is July 14, 2022. That's 13 years that they kept rates at zeros and stimulated. So if you think this is going away anytime soon, you better rethink that narrative. They kept the rates at zero, right? They bought up millions of dollars of bonds and printed untold sums of money, sending traditional asset prices surging while creating new assets. Think NFTs and doggy coins and other forms of crypto assets that have all imploded. Some worse than others, and that's only the beginning. Remember the merge? The most expensive NFT, non-fungible token in the short history of NFTs. That sold for, get ready, $91.8 million. I think that artist is brilliant. He, she, or they, whoever, conned 30,000 people to put up $3,000 each to buy a piece of this art. It's brilliant, really, but it speaks to the complete stupidity that exists in the herd mentality. The artist is laughing all the way to the bank, thinking, what were these people thinking anyway? $91.8 million. Is it me? Treasuries across the spectrum went bankrupt, right? They're all inverted. Which is why, which as you remember from Econ 101, is not bullish, right? The 2s are yielding 3.1%, the 5 are yielding 3%, the 10s are yielding 2.91%. So no matter which way you arrange them, you can't deny the whole treasury market is in a mess. It's turned upside down. When short rates are yielding more than longer rates, you call mission control and say, hey, Houston, we've got a problem. The dollar continues to rise as rising interest rates tend to attract foreign investors into the currency markets increasing the demand and value of the U.S. dollar. The dollar index closed at another new high last night, 108.35. Now, before you start screaming, yes, it traded higher on Tuesday intraday, but it closed lower. Yesterday, it traded in a tighter range, but closed higher. And that continues to put pressure on commodities, right? Remember, commodities are priced in dollars. So as the dollar gets stronger, it usually forces commodity prices lower, while a weaker dollar will force commodity prices to rise. Oil, which is the most discussed commodity at the moment, continued trading erratically. This is Joey's making a surprise trip to the desert to beg the Saudis to pump more oil because we don't have enough in our own country. Oil traded as high as 96.75, as low as 95.47, to end the day at 96.40. The Bloomberg Commodity Index, otherwise known as the BCOM, was also all over the place. A high of 114.50, a low of 111.53, to end the day right smack in the middle of 113.66, which was up 1.5% on the day, but is still down 18% since June 1. So that is okay. Now remember, the BCOM includes nat gas, crude oil, gold, silver, soybeans, corn, wheat, hog, sugar, coffee, zinc, copper, cattle, nickel, and aluminum, etc. So the idea that this group of commodities is coming down in price should take some pressure off of future CPI reads, but the jury's still out. We have to wait until August 10th to find that out. Recall that the CPI also includes the cost of housing in rental form. It's called the OER, or owner's equivalent rent, and that isn't going lower anytime soon. And just to remind you, you do need a roof over your head, the same way you need food and energy. So while food and energy prices may be going lower, rents are higher and going higher. This morning alone, we learned that a one-bedroom apartment in New York City has leased for $5,058 a month. That's a 600 square foot apartment. Maybe it has one closet, and you're lucky if it has a working stove and refrigerator. A dishwasher, don't even be ridiculous. Why would it? You can't have more than 2 people in the place. So how does anyone afford that? They demand higher wages just to pay the rent, saying that if you want me to come back to New York City, then pay me more money, which causes the landlord to say, well, if you're making more money, then I'm raising the rent. It's a vicious, vicious circle that's not going to end well. Now look, falling prices of commodities should help quell inflation. Yes, it should. The rising dollar, due mostly to rising U.S. interest rates, is at the root of the falling commodity prices. But consumers are also tiring of such high prices, and they're pulling back. So yes, Virginia, there really is a Santa Claus. And for those of you too young to understand that analogy, you got to go back and read the editorial from the New York Sun, dated September 21st, 1897. It came up as 1987 in my note. It's 1897. Okay, in any event, it's a great editorial, and for no other reason, you should read it because it's a great little piece that appeared, over a century ago. So you see, if rising interest rates are beginning to cause consumers to pull back, that's referred to as demand destruction. Then expect the Fed to keep going because they can't control supply. So what they try to do is destroy demand. So when consumers are not demanding products anymore, supplies will start to build up, and boom, you've now brought the demand-supply issue back into balance. Sales will start to take place as companies try to get rid of all this stuff in inventory, cutting prices by 20, 30, 50, or even 70% just to get it off their shelves and onto yours. And so what do? After you do that, you buy stuff at lower prices, and then you go out and you tell everybody you know about the bargains you found at Macy's, Nordstrom's, and Bloomie's. It's crazy, because what you should be buying are the stocks that are on sale, down 20, 30, and 40%. Stocks that meet the criteria of a Nordstrom's or Bloomie's, not stocks that meet the criteria of the dollar store, right? Think Kathy Woods' names, right? All that newfangled disruptive tech, which is having a very difficult time at the moment. So those are dollar store stocks, not like blue chip stocks, which are Bloomie's and Nordstroms. Now, no one wasted a moment opining on what the Fed's going to do next. In fact, at 10 o'clock yesterday morning, I tweeted out that I thought it would be only a matter of minutes before we saw and heard the 100 basis point conversation happen again. But who was the Fed going to select to start the conversation? Was it going to be Goldman again? Maybe JP Morgan? How about Citibank or Morgan Stanley? In fact, I thought it was going to be St. Louis Fed President Jimmy B, knowing he always has something to say. But alas, I was incorrect. They must have had him tied to the chair with a sock in his mouth, feeling that he would suggest the Fed needs to go 150 basis points or more. No, it wasn't Jimmy. It was a foreign bank that broke the story. So Zero Hedge put it out there. The Japanese investment bank Nomura economists now expect a 100 basis point Fed hike at the July FOMC meeting. And that threw the door open. Soon the whole street was abuzz. Atlanta's Rafi Bostic telling us after today's CPI report, everything is now on the table. Go ahead, read between the lines. And then Cleveland's Loretta Mester saying that the July rate hike had to be at least equal to the June hike. Again, wake up, read between the lines. I can't wait to hear what Goldman and the others now are going to say after the Fed approves this narrative. And then my very good friend Liz Ann Saunders, right, from Charlie Schwab. She is wonderful, and I have tremendous respect for her. She nailed the coffin shut, saying that the recession is sooner, not later, and the combination of a more aggressive Fed and a recession are the key ingredients in the recipe to bringing inflation down. Period. The end. Now, you know me. I'm big on recipes, so I loved that quote. This morning, U.S. futures are lower, and they're getting lower still. The dollar is up, Treasury prices are down, and yields are up as investors dissect yesterday's CPI and prepare for today's PPI, along with the first set of earnings results led by the big banks and the big asset managers, JP Morgan, Citibank, BlackRock, Morgan Stanley, Wells Fargo, Bank of America, etc. And we already got earnings from JP Morgan and Bank and Morgan Stanley. And investors are wrestling with the fact that the Fed, most likely, is going to get even more aggressive to stop the bleed. The economic data today includes the usual suspects, initial jobless claims and continuing claims. But the focus is going to be on the 8:30 a.m. release of the producer price index, because that reflects what's happening at the producer level. By now you realize that as prices rise there, they eventually rise at the consumer level. Today's report is expected to rise by 0.8% month over month and 10.7% year over year, essentially in line with last month. Which really means while it's not going up necessarily, it's not going down either. So elevated prices are expected to remain high. Gabish? But let's see how Press Secretary Karine Jean-Pierre handles that question. I can't wait to see her response. As I pointed out in Tuesday's blog, the market has sold off hard this year, right? A direct result of what the Fed would do, how aggressive they would be, how long it would go on, and what were the chances that they could maneuver a soft landing. Again, soft and landing should not be used in the same sentence. What stocks have not priced in yet are declining earnings estimates for the balance of this year and next year, along with weak forward guidance. So brace yourself. Just saying, get ready for more potholes ahead. And it's not the end of the world, but just get ready for rough roads. European stocks are all 1% lower across the zone. After yesterday's U.S. data, and all this does is raise the pressure on the European Central Bank and its president, Christine Lagarde. Remember, inflation across the Eurozone is running at plus 9%. It's at historic highs. And she still has rates in negative territory at negative 0.25%. Talk about tone deaf. Hello, knock, knock, wake up. Anybody home? I mean, it's unbelievable. So watch what she does over the next couple of weeks. The S&P closed last night at 3801. Smack in the middle of the trading range, 37.59 on the low, 38.29 on the high, leaving it down 21% year-to-date, solidly in bear market territory. The action this morning is suggesting we are on our way to testing the June lows of 3,600. Recall on Tuesday, I thought we would find support at 37.60, which we did, at least for yesterday. I'm assuming we're going to slice right through that. S&P futures at 5:30 a.m. suggest that we're going to test 37.60 on the opening, but today's PPI report could change all of that. If it's in line with the expectation, we could see investors and traders and algos find some relief. If it's hotter, then watch out below. And if it's cooler, then expect stocks are going to rally. Earnings began this morning after 6 a.m. and they're going to help and whether or not they help to change a tone is still up for grabs. Remember, you want to watch the guidance, and in this case, you want to watch what happens to loan loss reserves. An increase in reserves will lower earnings, and that will suggest that the banks are expecting borrowers to fail in the future. And that will tell you all you need to know. But remember, the big banks are relatively cheap. The XLF is down 20% year to date. Recall the Bloomies analogy. JP Morgan and Morgan Stanley both announced they both missed the estimates, increased loan loss reserves, and our JP Morgan is stopping buybacks. So that tells you even more. Now, stay focused. Continue to put money away in your tax advantage accounts. Maybe hold it in cash, but make sure you're putting it away. Okay, so what are we having for dinner tonight? Well, we're having something that's simple, cheap, and you can eat it 3 times a day. Breakfast, lunch, and dinner. Right? It's potatoes and eggs. And it's a time-honored favorite. It's real comfort food that won't break the bank. You can never go wrong with potatoes and eggs. And you, like I said, you can eat it 3 times a day. Breakfast, lunch, and dinner. So I hope you enjoy this, right? This reminds me once again of my childhood. Anyway, for this, you're going to need eggs, potatoes, garlic, onion, salt and pepper, butter, olive oil, fresh grated Parmesan cheese, and if you prefer a pinch of Italian seasoning, your call, your choice, however you like it. You want to preheat your broiler to high. Just get it ready. Now, in a large bowl, now you also want to peel the potatoes. Peel a couple of russet potatoes and then slice them. Don't slice them really thick. Slice them thin so you can cook them. Toss them in a pot of boiling water. Bring the pot to a boil and blanch it for 3 to 5 minutes. That's it. Just blanch them after you've sliced them. Remove them, strain them, rinse, put them under cool water, and set them aside. Now, in a large bowl, you're going to crack 6 to 8 eggs. You're going to beat them really well. You're going to add a splash of whole milk, or half and half if you prefer. Season it with salt and pepper, and if you like that pinch of Italian seasoning, add a handful of grated cheese. Mix it well. Now, set that aside. Now, you want to get a big oven-proof frying pan. Right? An oven-safe frying pan. You want to put a dollop of butter in the pan. You want to heat it up. Add a squirt of olive oil just so the butter doesn't burn. You want to heat it up. Now add in the chopped garlic and saute it around. Next, add in some of the sliced onions and saute until it's soft and golden. Add now back the potatoes and brown them on both sides, right? Let those cook. It's going to take 15 or 20 minutes for the potatoes to cook and take on a nice goldeny color. Now, when that's done, you want to pour the egg mixture into the pan and allow it to set. Twirl the pan, right? Twirl the pan like this to allow the egg to spread and cook. Once the edges begin to pull away from the pan, place the pan into the oven under the broiler. Watch it as it quickly cooks the top of now it's a frittata. Remove it from the oven and slide it onto a big serving platter and then cut it like you would a pizza, right? So cut across, make triangles. You want to have toasted slices of Italian bread on the table for the guests to make a sandwich. Oh my God, it's so good. And you serve this with ice cold whole milk. Nothing else, all right? No wine for this, just ice cold milk. This meal should cost you about $12 to $15 maybe to make, depending on how many people you make it for. You know, eggs are expensive. They've shot up in price. Potatoes, shot up in price. Butter, skyrocketing. Olive oil, up in price. So maybe it's 12 to 15 bucks in any event. It is going to be a beautiful day here in Florida. Not so sure what the day is going to be like in the markets. If this morning is any indication, it's going to be kind of a tough day. In any event, until tomorrow, take good care.